Hey guys, how you doing? Welcome to Millionaire Mafia. I'm Jake Chambers. I appreciate you guys coming here today. Today we are going to be talking about a property that we recently did a BRRRR on. If you aren't familiar with what a BRRRR is, I did a video on this recently, but it stands for Buy, Rehab, Rent, Refinance, and Repeat the Process. And that is literally the building blocks and the foundation of my business and a lot of other real estate investment professionals' businesses. I did a video on that specific process, and I'll link that up in the description and up above. But this particular deal has to do with a trifecta that I did a little while ago. And what I mean by that is I bought this property and it led to two other properties for a total of three properties, all due to buying this one. I actually did a video on this just recently about these three properties, not the details of them specifically, but just how the process worked and how I was able to turn one property into three cash flowing properties. If you want to look at that one again, I'll link that one as well, and you can check above. This property came to me from another wholesaler who had a property under contract, and he was looking to offload this property and assign the contract to another buyer. Now we'll talk about assignment of contracts and wholesaling in later videos, which a lot of people will call it flipping, and it is flipping, but you're not flipping the property itself. You're flipping the paper and the contract, and you're assigning that contract. We won't get into the details here, but what he did is he had a property under contract, and I was going to take his place as the buyer. So I had to, though, figure out if it was a good deal to buy, if it was a contract that I wanted to take his place on. So that's what I'm going to show you guys today. I'm going to show you guys the underwriting process. I'm going to show you guys not only how I ran my numbers, but also how we executed the rehab process, how we kind of made some adjustments based off a very, let's call it interesting situation that happened shortly after closing. And then I'm going to talk to you about the reason why I went with the disposition plan or the exit strategy that I did on this particular property. So let's go ahead and get into this real quick. I'm going to go ahead and take you to my screen. I'm going to overlay that here in a second. But really quick, the property itself, let's talk about that first. What it was what we call a CBS, a concrete block on slab. This was a 3-bedroom, 1-bathroom house located in Pensacola. It was approximately 1,400 square feet, and it had a brand new roof, and it had basically been rewired. It was aluminum wiring, and they made it to copper. Now it wasn't completed. Everything was run, and a lot of it was run to the box, but there were some things that needed to be done. So it was about 75% done. It also had all the cabinets that were in there, and they were solid wood. Now they weren't super fancy or anything. They were a little older, but they were in that really good condition, and they were fine. We were going to paint them to freshen them up a little bit, but they were fine. It had looked like a brand new, nothing fancy, but Formica countertop. It had a nice sink, really nice faucet for the sink. It had a refrigerator. It had a stove. They were both in great condition and working. It had a brand new insert for the tub, like a tub shower, fiberglass insert, like really sharp. It had a bunch of supplies, wood, lumber for, fixing some of the WDO stuff. And it had tools, it had ladder, it had some other stuff that was all with this property. And I confirmed with the wholesaler. I said, "Hey, does this stuff all come with it?" And he said, "Yes, it does. This is what the house is going to look like." I said, "Okay." And he said, "Yeah, I mean, there were some old couches and beds, and it's pretty typical. We got to do a junk out." So I figured that was the case. So those were some of the good things. The I guess you'd call it downside is that it was gutted. Other than that, down to the studs. So all the drywall was ripped off, all the way down to the furring strips, and so it was just concrete block on the inside. But, not a big deal. It's nothing. It actually was a clean slate, and it gave us something to work with. And then we obviously have to do the floors and everything. So that kind of paints the picture. And the seller or the wholesaler was asking $70,000 for the property. So now let's take it to the screen and we'll go ahead and do our number crunching. Okay, so here we go. All right, so we'll come to this sheet here, and like I said, he was asking $70,000, right? So I'm gonna write that down there. And at first, I was going to flip this property. I had a couple of properties going at the same time, so I was going to just make a quick flip, and I had to run those numbers. At the time, it's probably worth more now, but it was worth about $140,000. Okay, so I did my numbers based off everything that needed to be done: drywall, flooring. I was gonna, for a flip, I was gonna paint the cabinets and things like that. But I was gonna need about $35,000 in repairs. And we always run our numbers for both a flip and a rental, just to make sure we've got multiple exit strategies. But I was gonna run it at about $25,000 for a rental. Okay. I'll put in here flip so that you guys can remember that. So that was our main number. So we were going to either be in for 105 or 95, right? Flip or rental. Got it? Okay. So let's run worst case scenario in the flip, and we always run that. So we're going to say 105,000. 105K. We know that when we sell a property, we're going to have to pay about 7% in closing costs. That's buyers and sellers, agent, the brokerage fees, any titles, taxes, all those kind of things. So we need to multiply that times 7% when the fraction is 0.07. Okay, and that's going to equal about 10,000. It's like $9,800. So that equals about gives us 130,000 left over. See what I mean? 140,000 sales price, but I have to pay 10 in closing, so I have 130,000. And if I have $70,000 in purchase price and 35,000 in the flip, and we haven't even put front side closing in there. We would normally do that, but we're just doing kind of basic numbers here, and I'll explain why. So we're in for about 105,000. So that leaves us equals 25,000. Okay, not bad, right? 25,000 is not a terrible flip. But what do we have to take into consideration? Minus taxes. And that's about 35%. 25, that ends up being just under 10 grand, right? So it leaves us with about, it's a little bit over 16,000. It's 16,250 when all is said and done. So that is our true net profit. Okay? So that's what we got to be looking at, is that number. This looks great, but when you factor in what's going to actually happen with those taxes, it doesn't look so great. So that's the number that matters. Now we need to figure out what it's going to do, or what we need to get. So we were okay with about 25,000. I typically want to make about 25,000 to 30,000 as a minimum for my flips. This is a smaller property. It's relatively straightforward. So I'm okay on the lower side of 25. So you can see we were making about $26,000 right here. So if we ended up making 16,000 after taxes, in order for us to make it a decent amount, we're actually going to need to make about 10 more. So what does that go to my offer? That makes me reduce that offer by about $10,000. Okay, so I actually need to offer $60,000, which is what my offer was to the wholesaler. Okay, and so that's going to equal about, I'm doing some rounding here, right? But that's going to equal after taxes about 25,000 net in my pocket. Now, there's selling it for a little bit more and having a little bit less into it. There are some taxes in there, but it's close enough, right? We're within rounding area here. So $25,000 is my net profit at 60,000. Next, we got to run it as a rental because we want to see what makes sense. So we don't want to be any more into it than 70%. The reason is because most banks will actually give us 75% loan to value. Not all. Some give a little bit more, some give less. But the reason is that extra 5% between 70 and 75 is typically eaten up by our closing costs on that loan. So the points, the underwriting fees, and all that other kind of stuff. So we got to basically figure out what that is. So if we're at 140,000 times 0.75 is 105,000. 105K is the most that we can be all in, including the closing costs. And it's going to be about $5,000 for a loan this size. So minus 5,000, right, equals, pretty straightforward, 100,000. So our loan is going to be $100,000, right, for 140,000. That's the most that we can be all in. $25,000 rehab. So we'll subtract 25,000 equals $75,000. So you can see here, 75,000 is actually what we could pay on a rental for a little bit more. So you can pay a little bit more on a rental because you can pull it out on the backside. However, you got to go with, for me, and this is my strategy. This is how I do it, especially in these lower income houses. I want to be all in for the lowest of the two. Sometimes the flip you can actually be in for more because I'm looking for a specific number, a net profit, not a percentage of a return. But for a lower priced house, typically the flip, you actually have to buy at a lower price because the cost of materials and labor doesn't really change when you're on those lower houses. So when you're on bigger houses where you're maybe $300,000, $400,000, or $500,000 sales prices, you can spend a little bit more because your net profit in the end might be six figures. Now, you might have a lot more into it, so the percentage is either the same or maybe even a little bit less than on a smaller property. But if you get in and you're not able to make any money, like what's the point of doing it? Even if your percentage is high, what's the point if you don't make enough, right? So anyway, so I could have been 75 in here, but what I do is I take the lowest of the two, right? I need to maximize my ability to exit as safely as possible. And sometimes that doesn't work for everybody. Sometimes that doesn't work for the wholesalers, and I totally understand that, and I respect it. I'm a wholesaler myself, and sometimes I just can't do a price. Well, in this particular instance, the wholesaler, my buddy, said it would work, and it worked for him. He made money, and he didn't have to close the deal, bring any money to the table, do any of the rehab, and deal with any of the stuff that I'm going to talk about here in a minute. You got in, you got out, next deal, boom. And that's an advantage of wholesaling a deal. So I ended up offering $60,000, right? And I'll leave this here. So $60,000, and it was accepted. All right, cool. So we're all in for $60,000. Now we need to figure out, when this is done, how much is it going to rent for? We're looking at about $1,100, and unfortunately I went low. I went too low. I should be at like $1,300 now. The market's just, boom, rapidly changing. But I went $1,100 a month to be conservative. So we need to figure out what our expenses are. Well, a mortgage on $105,000, right? Because just because we ran at 100, that 5,000 still does have a loan against it, because that, those closing costs get wrapped in the loan, but you still got to pay them. So $105,000 mortgage comes out to, I'm just going to write this, equals $535. These are all going to be per month, okay? And then taxes for the area, you can look that up on county records. They will change typically after you buy it, but you can get a general trend. About 85 is about $1,000 a year. Insurance is $75 a month. And property management. Now, I manage my own properties, but you still have to factor that in, because in the event that you have to have somebody take it over, or you get to a point where you are so big that you can't manage your properties anymore, you have to account for that. Typically in most areas, especially for residential, it's about 10%. Could be a little bit more, could be a little bit less. There's some other things to factor in there, and I talk about that in my video on doing the BRRRR process, the buy, rehab, rent, refinance, and repeat process, which is literally what we're doing here, but I go into some specifics on talking to and with property management companies and contractors and things like that in there, and what's all wrapped into management fees, right? It's typically a lot more than that, just that baseline percentage, right? So just keep that in mind. Check out that video. I'll link it up above. I'll put it in the description so you guys can check it out. But we'll just say 10%. And again, I'm not actually paying that, but I may have to, so I have to account for it. All right, so that's going to be $110, right? 10% of $1,100, because that's of your gross receipts. And then you've got repairs and maintenance. Okay, and that's about 5%, right? We just fixed this property up, so it's not going to need a whole lot. So that's, what do we say, $55 a month. And then we have CapEx. So in that video that I mentioned about doing the BRRRR process, I explained what CapEx is. But think of CapEx as your long term, your once in a blue moon type items like your roof, doing a rewire, your HVAC, anything that typically lasts 12 to 15 years or more in your property. So think of stuff like that. And what you're doing is you're putting a little bit away each month so that when you hit that point 5, 10, 15, 20 years from now, you've got plenty of money and you don't have to worry about getting hit in the face in that particular year, right? And then if you get to a certain point where you're like, okay, everything that I would need to replace, I have enough for in some type of savings account or whatever, low interest bearing, easily accessible, highly liquid account, then stop putting into it. That's fine, but don't stop putting into it until, or at least have it available until you've saved up that amount. So because we had a new roof, because it had just had a rewire, it had a 2-year-old HVAC, and the plumbing was all in good shape, it really didn't need much, so we did it at 5% as well. If you have a property that's older and has some deferred maintenance, you might need to up that, right? If that roof is coming up, it's not done yet, but it's coming up, you might need to account for that. So there's another $55. The grand total of that, without doing all the math on the calculator, is $910 a month in expenses. Okay, and then we said $1,100 is rent, so that means that we have it was $915. I can't do math, so you guys are probably yelling, oh, you idiot. $185 per month, I'll scroll this down so you can see this, is my cash flow. And that's true cash flow because I've not only accounted for my, no kidding, out-of-pocket expenses, but also my long-term liabilities down the road. So that's what goes into my pocket, which equals $2,200 per year. Not too shabby, but it can get better. But we'll talk about that in a minute. So now that's if it's leveraged, right? And what that means is if it has a loan on it, right? Okay, so now let's go into an unleveraged. So everything down here is pretty much going to be the same, right? Except what? Exactly, mortgage, right? I don't have that anymore, so I can delete it. So you subtract 535 from 915, you get $780 per month cash flow. Not bad, right? Which equals 8,600 and I think 40 per year. That's really good. So why wouldn't we do this option? That's 4 times as much. Well, what's the caveat there? We have a lot less on expenses, but what do we also have a lot more of in the deal? Exactly, we've got a lot more money, right? We have all that. We said we're buying it for 60, and we're anticipating putting 25,000 into it. That comes out to 85,000. So we've got $85,000 in this deal of our own money that's in this, versus the other option where we actually not only took our $85,000 that we bought and rehabbed the property with, but remember, we closed and we got a $100,000 check at closing. We have $100,000 in our pocket, which is $15,000 more, and $185 a month, right? So yeah, less cash flow each month, but we have the property and we have all of our money back, so we can go do it again. So on one hand, we have a higher monthly cash flow at a higher basis, meaning we have a lot more of our own money into it, a higher personal basis. But on the other hand, we have the zero basis of our own personal net worth into the property, and we essentially have an infinite return because we have no money and we're getting cash flow each month. But it gets even better than that. In both cases, it's good. Like, we're good in both cases. I just will show you the difference between why one you may want to go with over the other, and why, like my video I did on how I disagree completely with Dave Ramsey and how debt is bad, and that is that if you leverage appropriately and you use debt effectively and how it's designed to be used by smart people, you can make a ton of money safely and efficiently and relatively easy as long as you can find deals in real estate. We have to talk about the 4 ways that you make money in rental properties. This is different than flips. There's only going to be one way in a flip that you make money, is if you buy it and it appreciates, or either over time, or you force the appreciation by making it better and fixing it up. And you're really not forcing the appreciation, because you can't make it worth any more than it is fixed up. But it was in a bad shape, so you fixed it up, and now it can be compared to other properties of the same size, location, and build, and things like that, age. Number one, cash flow. That's the easiest one to see. It's that check, that $185 a month that comes in your pocket. Number two, this is the other one that's actually kind of quantifiable, that you can actually see. It doesn't go in your pocket per se, but it actually goes onto your net worth every month, and that is principal pay down, right? So you've got a mortgage, and we're assuming the leverage example here. We've got a mortgage. Say we're paying $150 towards the principal payment, and all the rest of that $535 is going towards interest, money it costs to borrow the money from the bank. Okay, so that's a lot of interest. But remember, who's paying that interest? We aren't. The tenant is, through their rent. Who's paying the principal? We aren't. The tenant is, through their rent. Let's say it's $150. So we have to add that, right? So we've already got $185 a month for cash flow. And then we also have $150 a month for principal pay down. Oh God, I don't know if I spelled that wrong, if that's the right principal. I remember one, his principal was like your buddy, and I don't know. Anyway, money's my buddy, so I think I'm probably spelling that wrong. Okay, that's number two. Number three is appreciation. So I never count on appreciation being there for me. Historically and statistically, real estate will continue to trend up. A lot of times that is countered by inflation. So while it may have a higher price point over time, the cost of money gets a lot more expensive, right? And it's harder, like, to buy things with the same dollar, right? You know, a dollar back in 1970 is worth a lot less, or a lot more than it is now, right? So that's essentially a wash, and a lot of people don't realize that. But that's a third one, right? If you bought the property and, like, right now it's worth 140, 150, well, in 10 years, if I were to sell it, maybe it's worth 250. So that appreciated over that time. Again, that doesn't take into account the fact that everything else is more expensive, but here nor there. That's a gain that you don't see in your pocket, but you will over time. You'll realize when you sell. And the fourth one, which a lot of people forget about, or don't think about, or don't even know about, or don't conceptualize, is depreciation. Now, what do I mean by that? Depreciation isn't like your car when you drive it off in your brand new F-150, you drive it off the lot, and it's automatically worth 15% less than the day you bought it. That's not what I mean by depreciation. Depreciation, while it's similar, as far as the IRS is concerned, a residential property depreciates and has a usable lifespan of 27 and a half years. Commercial is a little bit more at 39 years. We won't get into that here, but 27 and a half years. So, and it's basically, you know, not transferable, but it's also, it resets when you sell it. So if I were to sell it to you and I've used up 27 years, you don't get just a half a year of depreciation. You get to reset the clock for 27 and a half years for you, right? And we obviously know houses last, unless they burn down or get knocked over, a lot longer than 27 and a half years. So we have this, let's call our basis in this, our planned basis in this property, $85,000, right, is what we had planned on, and we get to divide it by 27.5, and that equals, I'm just going to do some rounding here, and it equals about $3,000 per year that we get to write off from our taxes. Now, this isn't a credit, unfortunately. You don't just get $3,000 back. You get $3,000 worth of taxable income knocked off, shaved off. And when you compare this number to this number, right, that completely negates it. Plus, you've got an extra $800 there, or it knocks off, you know, about a third of that number right there. So, awesome. Now, what that equates to, the better way to look at that, though, is that equals approximately $1,200 per year at 35% interest or taxes. So your taxes are going to be about 35% on, you know, at your tax bracket. Now, again, everybody's different. Some people are effective of 0, some people are higher, some people are lower.
you're going to have to, structure yourself with your CPA and your tax strategist the best way possible, and they'll help you with that. I'm not a tax consultant. I'm not giving legal or financial advice. However, I'm just using this as kind of what we use industry standard as our tax bracket. Again, that will change over time. But at 35%, that's about $1,200 that you would have to pay. If you made $3,000, you would pay about $1,200 in taxes on that money. So that $1,200 is not money that you get, it's money that you don't spend, which is essentially the same thing, right? And nice easy math there, that comes out to $100 a month. We'll call it depreciation. There you go, 100 depreciation. And let's do the simple math. That equals, oh boy, I can't do simple. 300, 435? Yeah, $435 per month cash flow equals probably just a shade over $5,000, right? 435 times 12, 5222, or 20, excuse me. So that is effectively, not actually, that's not actually going in your pocket, but that is essentially what is going towards your net worth in the form of cash flow, or depreciation, and principal pay down. We haven't even talked about it, but that doesn't factor in appreciation, which could be significantly more. But if it goes up or down, we're cash flow investors. We don't care about that. That's all I'm trying to show you here. Without, that, I just wanted to show you how that works and how I analyze these deals. But all that was to show you that
it can be done. This deal makes sense. Okay, so I said, all right, D, we're going to do this, right? Sorry, here's your name. Hopefully you don't mind, buddy. But anyway, we're going to go ahead and do this. He said, all right, I'm good with it. So we went under contract and we closed the deal. It was really a pretty straightforward process. Unfortunately, the day of closing, it was a cash buyer, so I signed the paperwork remotely, but I got really sick. I just got a stomach bug or something, and so normally it's a rule of mine is when I close on a property, I go to the house that day, I do an inspection, I withhold funding the deal, even though the funds are in escrow. I tell the title company, do not release funds until I give you the go-ahead. And I'm going there to make sure everything is right the way it was the day before, right before I was getting ready to close, when I did my final walkthrough, and I changed the locks. Well, I was sick. I said, okay, so I broke my rule because I wasn't feeling good, and I ended up going not Thursday, not Friday, not Saturday, Sunday, on Monday when I felt better, and we went in there to go change the locks and get started and figure out what we were going to be doing. Well, I go in, open the door, get ready to change the locks, and I look in there, and somebody had gone in and finished the gut. They had removed everything, not only the stuff that wasn't nailed down, but the stuff that was nailed down. All the materials that were there, the shower, brand new fiberglass insert, the vanities, the mirrors, all the cabinets that were loose, that were extras, that went on the walls, and they ripped everything off the walls as well, and to include the brand new countertop, all the sink, the everything. All the appliances were gone. So that was about $7,500 in materials like that. Not to mention it would probably cost me about $5,000 to install those cabinets and the countertops and all the plumbing and everything. Oh, plus we also had to order appliances during this material shortage, which can take 3 months to get a damn refrigerator, right? So needless to say, it was a little bit frustrating, right? So my wife was ready to go bury a body in an unmarked grave somewhere. I was upset and frustrated, but what am I going to do, right? So actually the wholesaler that I bought it from did a little PI work and found the guy through an Instagram post from a friend of a friend. Had actually the seller had gone into the house, and we're in Florida. He ended up moving up to New York right away. He had gone in on Friday, so the day after it was legally mine, and stolen everything out of the property. So we long story short, we found out it was him. Everybody was telling me, hey, you should press charges and do this. And I said, yeah, I should, probably. But at the end of the day, what's it going to solve? Those materials were gone. There's no way I was going to get those back. It was going to be months, if not years, to get them, plus all the time and energy and aggravation. Yeah, it sucks to lose that money, but we just had to make some changes. We had to pivot. So what did we do? Well, we had planned on hiring out all the labor to get things done. Fortunately, over the years, something I've become very good at, myself, my wife, and my kids, is laying floors and painting and cleaning. Okay, so we ended up taking on the labor of the flooring and painting all the cabinets and doing trim and things like that, installing trim, quarter round, baseboard, all that stuff, as well as doing the major clean out, the construction clean out and make ready prior to closing. So that was what we had to do, and it is what it is. It kind of sucked, but we did it. After we got everything done, the good news is that we came all in at just a shade over $20,000 in total material cost and labor. Now, there was a lot of our own personal labor, but that is what it is. So that does have a time value, but we enjoyed it. We learned a lot, and the kids learned a lot. They were able to do homeschooling while they were at the property here and there. So we got stuff done, and they learned a valuable skill as well as a life lesson, right? We were all in for $60,000 for the purchase. It was approximately $1,500 for closing. It was approximately $1,000 for holding costs, meaning we had to pay kind of the construction insurance, right? While it's vacant, you're working on it. And then we also had to pay for utilities, right? Electric, water, sewer, trash, all those things while we were holding it, dump fees, things like that. Anyway, that was about $62,500, right? And then about $20,000. So we were all in about $82,500. So we were $2,500 under budget, which is great on a rental. And so I had a tenant lined up, ready to go, vetted, and she actually paid a year in advance. Nice lady, paid a year in advance on this property before I even had the thing ready to go. We were literally mopping the floors and letting him dry while I was handing over the keys outside to the tenant and told her, hey, come back in an hour when it's dry. So that's how efficient we were. All right. That's all I wanted to talk to you about today, that specific deal. While the other deals are similar, as far as how I evaluated them, how we rehabbed them, and how we ran our numbers, and what the plan is on the backside for the disposition, how I acquired them is different. But the other thing is that repetition is key, right? So I'm doing this for you, so that you can see, okay, this is how he did this deal, and here's the numbers. And then the next time, it's going to be very similar, but there are going to be some differences, some nuances that are different. So look for those, and then use that repetition, not only on this deal, but so I'm doing the numbers the same way, but I'm going to do them on a different property, so you can see if things change and how that adds up over time. The other thing, and this is a selfish reason, I guess, for me, but I'm doing this as essentially a training module for my kids and my team down the road, so that they can see how we evaluate deals and underwrite. So when I have my kids who are going to be working in the company, at least I hope, and they're going to be able to look at this and see, okay, here's what we were looking for. I was there, it didn't really register because I was only 8 or 10 or 12, but I remember it, and this is why, okay, that makes sense why we did this, and this makes sense why we went this way versus that direction. And then they can actually look at not only that, but the nuts and bolts, and like, okay, here's how we evaluate a deal. Here's why we have to buy at a certain price point based off of the environmental and economic factors at play at the time, right? So use this. If you want to take this, rip off and duplicate, right? And make it your own and make a Loom video with it or do whatever, or just take this video and be like, hey, look at this one. Dude, totally fine. I mean, it's YouTube. Like we all do this, right? That's how you learn how to do things. Take this, take what you like, take what you didn't like. If you see something that was wrong or that you didn't understand or you didn't agree with that I mentioned, please comment below. I really want to know your opinion. There's a lot of information here. It's easy to sometimes miss things if Anybody who knows the details or experienced this specific situation differently, please let me know. I want to make sure I get the details right. Any errors, or whether of commission or omission, were unintentional, I promise. But anyway, let me know. I would love to see your comments. I would love to know about your most recent deal, about maybe something crazy like how I had my property ganked right out from under me because I was an idiot and didn't go and change the locks, and how that's a lesson that I will never screw up again. What is the life lesson that you've learned based off of a major screw up that you've done? I want to know. Go ahead and comment below. All right, guys. Thanks again for joining me. I really enjoyed this one. I know it was longer, but this is a nuts and bolts, down and dirty, in the weeds, here's how you do the do type of video. And these, if you want to get wealthy, if you want to learn this business, you got to watch videos like this. I know it's probably a little bit painful at times. I'm trying to be energetic. I'm trying to give you guys good information. But this is it. This is my life, and a lot of my peers and my mentors and my supporters. This is how we do our job. So it's really not any more complicated than that. And we do the same thing for big commercial deals, for our 20, 30, 40, 50, 80 plus unit deals. There's some other things that go into it. It's very similar, the same concept, right? Figure out what your expenses are, and figure out what your income is, and figure out where your deferred maintenance is, what it's going to cost, what you can get the money for as far as from the bank, and how you can structure the deal to maximize your cash flow, and what all of the incomes are going to be, both cash flow, appreciation, depreciation, and principal paydown. Run the numbers, and then buy the deal or don't buy the deal. It's super easy. You just got to do it. Watch this video a couple times. All right. Hit me up if you got any questions, okay? Comment below. If you know my number already, go ahead and call it. If you don't, ask me. Hit me up on Facebook. Just Jake Chambers on Facebook. You'll see me on there. You'll see the Millionaire Mafia, homepage picture with me flying a Cobra. And I will be more than happy to DM you my number, and we can chat as much as you want about this stuff, okay? All right, guys. Really appreciate it. Thanks again. We'll be dropping videos left and right as long as I can do it, right? So I really appreciate the encouragement that you guys have given me, both online and offline. So anyway, I'm doing this. I'm doing this for you guys. I'm doing this for all of us. So I really appreciate all the support. All right. Till next time, here's to your wealth.